tracking error is the standard deviation of difference between daily returns of the NAV and the index. So let's take a simple example that today the index has gone up 1% and your fund has gone up, say, 0.99%, right? So there's a 0.01% gap between the returns of your fund and the returns of the index. Now that 0.001 is calculated for the entire year. So the difference between the returns, that means the difference between the index returns and the difference between the between your NAV, that difference in returns is calculated on a daily basis for 250 trading days, which is 1 year. A simple example could be that there might be a fund which at the end of the day, end of the year has given, an index has given 15% return and the fund has given 15% return, but the tracking error is high, right? Which means that there have been cases where the fund manager has not been tracking the index, right? There could be an instance where a scheme has given 15% return and the index has given 15% return, but the tracking error is very low, which means that that fund manager has been managing the index and his portfolio very well on a day-to-day basis. Whether it is an index fund or an ETF, the tracking error is disseminated, and that's one figure that all investors should